Why would a company weaken a profitable business before its replacement had even proven that it could work? In 2007, Netflix was still best known for mailing DVDs in red envelopes. The model was growing. It had millions of subscribers, a large catalog, and a service that had already changed how people rented movies. Customers no longer needed to visit a store, worry about late fees, or choose from whatever happened to be available on a shelf. At the same time, Netflix introduced a very different way to watch: streaming. But this was not yet the streaming business we know today. Internet connections were slower. Connected televisions were rare. Licensing rights were limited. The online catalog was much smaller than the DVD library. Even Netflix did not know how quickly customers would change their habits, or whether online viewing could become a profitable business on its own. The obvious strategy would have been to protect the DVD operation for as long as possible. That was the business generating revenue. That was the service customers understood. That was where Netflix had built its logistics network, its recommendation system, and its competitive advantage. Streaming, by comparison, was uncertain. And yet Netflix began moving attention capital and strategic priority toward it long before success was guaranteed. This creates a difficult question. Why would a company deliberately make its strongest business less important while that business was still working? The common explanation is that new technology naturally replaces old technology. Streaming was faster and more convenient, so DVDs were always going to disappear. But that explanation makes the transition look much easier than it really was. Technologies do not replace business models automatically. Companies must decide when to invest, which customers to prioritize, where to allocate resources, and how much damage they are willing to accept in the present for a future that may not arrive as expected. For Netflix, the risk was not theoretical. Its DVD business had real customers, real revenue, and real operational advantages. Streaming required new licensing agreements, new technology, new device partnerships, and a new way of measuring customer behavior. It also threatened the economics of the service that had made Netflix successful in the first place. Moving too early could destroy value. Moving too late could leave Netflix trapped in a declining model while competitors built the future without it. That is what makes this story more than a simple transition from discs to digital video. It is a story about how a company decides what to protect, what to sacrifice, and when to stop allowing its current success to control its next move. Because the most important decision Netflix made was not launching streaming. It was choosing to treat streaming as the future before the future had become certain. To understand why Netflix was willing to shift its priorities, it is important to understand what made its DVD business so successful in the first place. When Netflix launched its subscription-by-mail model in the late 1990s, it solved several problems that had frustrated movie renters for years. Traditional video rental chains depended on physical stores, limited shelf space, and late fees that often generated a significant share of their profits. Netflix replaced that experience with a monthly subscription, unlimited rentals, personalized recommendations, and home delivery. It was not simply a better way to rent movies. It was a fundamentally different operating model. Instead of competing store by store, Netflix built a nationwide distribution network supported by regional shipping centers. Customers created an online queue, DVDs arrived by mail, and return discs were quickly processed and sent to the next subscriber. The system became increasingly efficient as scale improved. Just as important, Netflix collected something that traditional rental stores rarely possessed: data. Every movie added to queue, every rental completed, and every customer preference helped improve the recommendation engine. The company became better at matching people with content, increasing customer satisfaction without constantly expanding marketing spending. By the middle of the 2007, this model was producing impressive results. Netflix had approximately 7.5 million subscribers, and according to its annual report, its DVD catalog contained nearly 90,000 titles. The business was profitable, recognizable, and still expanding across the United States. At first glance, there seemed to be little reason to disrupt it. Yet the strengths of the DVD business also revealed its limits. Every additional viewing required a physical disc to exist somewhere in the network. Every shipment depended on transportation, sorting facilities, and postal delivery. Growth required more inventory, more logistics capacity, and more operational complexity. The customer experience, while much better than visiting a rental store, still included waiting for the next envelope to arrive. Streaming promised something very different. A movie could begin within seconds. There were no shipping costs for each viewing, no return discs to process, and no physical inventory moving around the country. If the technology matured, the economics of content distribution could change dramatically. But in 2007, that future was still incomplete. Netflix launched its Watch Now service with only a small fraction of the titles available on DVD. The online catalog contained only a few thousand selections, while the physical library remained vastly larger. Broadband access varied widely, many households lacked compatible devices, and licensing agreements for digital distribution were still developing. Even Netflix acknowledged these realities in its filings. The company continued investing heavily in its DVD operation because it expected physical media to remain important for years. Streaming was introduced alongside the existing service rather than as a replacement. For a time, the two businesses depended on each other. The DVD operation generated revenue, retained subscribers, and financed investments that streaming could not yet support on its own. Customers often subscribed because they wanted access to the complete DVD catalog while gradually experimenting with online viewing whenever suitable titles were available. From the outside, maintaining this balance appeared sensible. One business generated reliable cash flow. The other represented an uncertain possibility. The difficult question was no longer whether streaming had potential. It was whether a company could continue treating its established business as the center of its strategy once a completely different model had begun to emerge. The balance between DVDs and streaming did not begin to change because the DVD business stopped working. It changed because Netflix started redefining what business it believed it was actually in. In its earlier years, success had been measured by how efficiently the company could move physical discs through its distribution network. Better logistics meant faster deliveries. Faster deliveries meant happier customers. Happier customers meant higher retention. But streaming required a completely different way of thinking. Success would no longer depend on moving products more efficiently. It would depend on delivering entertainment instantly, across many devices, with as little friction as possible. That shift affected almost every major decision inside the company. Netflix had to negotiate digital licensing rights that were separate from traditional DVD agreements. It had to build relationships with manufacturers of televisions, game consoles, Blu-ray players, and streaming devices. It had to invest heavily in software engineering, cloud infrastructure, recommendation systems, and user experience instead of simply expanding distribution centers. None of these investments produced immediate financial certainty. They reduced short-term flexibility while preparing for a market that had not fully arrived. By 2010, the company's language had already begun to reflect this change. Reed Hastings increasingly described Netflix not as a DVD rental company experimenting with online video, but as a streaming company that also happened to offer DVDs. The priority had quietly shifted. The most visible evidence appeared the following year. In July 2011, Netflix announced that customers who wanted both streaming and DVDs would need separate subscriptions instead of the combined plan they had previously enjoyed. For many households, the total monthly price increased significantly. Soon afterward, the company announced that the DVD business would operate under a separate brand called Qwixter, while Netflix would focus on streaming. From an operational perspective, the reasoning appeared understandable. The two services required different technologies, different cost structures, different partnerships, and increasingly different strategic priorities. Customers saw something else. Instead of viewing the separation as organizational clarity, many interpreted it as unnecessary complexity combined with a sudden price increase. The reaction was immediate. Subscriber growth reversed. Customer satisfaction declined. Netflix's share price fell dramatically over the following months, and the Qwixter plan was abandoned before it was fully implemented. For many observers, this looked like proof that Netflix had made a catastrophic strategic mistake. But there is an important distinction. The backlash demonstrated that the execution of the transition had serious flaws. It did not automatically prove that the direction of the transition was wrong. Despite the criticism, Netflix did not return to treating DVDs as the center of its future. The company acknowledged mistakes in communication and customer experience, yet it continued investing aggressively in streaming technology, digital content, and platform expansion. That decision deserves careful attention. Most companies facing this level of public criticism would be tempted to slow down, protect the profitable business, and postpone disruptive investments until uncertainty disappeared. Netflix chose a different path. The company accepted immediate financial pain, reputational damage, and operational disruption without abandoning the long-term commitment it had already made. The critical question then is not why Netflix made mistakes during the transition. It is why the company continued prioritizing a strategy that had just produced one of the most painful crises in its history. The turning point in this story becomes much clearer once we stop looking at DVDs and streaming as two products, competing for the same customer. From Netflix's perspective, they represented two very different sets of capabilities. The DVD business rewarded operational excellence. Every improvement came from making an existing system more efficient. Faster shipping, better inventory management, more accurate recommendations, and lower distribution costs all strengthened the same business model. Streaming rewarded something else entirely. Its long-term advantage would depend on digital infrastructure, software development, content licensing, device integration, and eventually original programming. None of those capabilities could be developed overnight, and none of them became valuable only after streaming reached mass adoption. They became valuable because they required years of learning before the market fully shifted. This changes the way the transition should be interpreted. The common assumption is that successful companies lose because they fail to recognize new technologies. Netflix did recognize the new technology. The more difficult challenge was deciding when that technology deserved priority over a business that was still generating healthy returns. Keeping DVDs at the center of the company would have seemed financially rational. The business already had paying customers, predictable cash flow, and operational scale. Every additional investment in DVDs could likely have produced another period of profitable growth. But those same incentives carried an invisible cost. Management attention, engineering talent, financial resources, and organizational focus are always limited. Every dollar invested in expanding distribution centers was a dollar not invested in streaming infrastructure. Every effort spent refining physical logistics was effort not spent solving digital distribution. The conflict was never simply between DVDs and streaming. It was between optimizing the present and preparing for a different future. This helps explain why Netflix continued supporting its DVD service while gradually changing what determined the company's strategic decisions. The DVD business did not disappear overnight. In fact, it continued serving customers for more than a decade after streaming was introduced, with Netflix mailing its final discs only in September 2023. That timeline is revealing. Netflix never attempted to destroy the DVD business as quickly as possible. Instead, it prevented the DVD business from deciding where the company would invest next. Those are two very different actions. The DVDs continued generating value. What changed was their influence over the company's future. That distinction also explains why the crisis of 2011 did not reverse Netflix's long-term direction. The company admitted mistakes in how it separated the services and communicated with customers, but it did not conclude that streaming should return to being a secondary initiative. By then, the organization had already accepted a different strategic reality. The greatest danger was no longer that streaming might fail. The greater danger was allowing a successful existing business to consume the time, talent, and investment needed to build the capabilities required for the next era of entertainment. Seen from that perspective, Netflix was not abandoning a profitable business because it believed streaming was guaranteed to win. It was reducing the power of its current success before that success became the reason it could no longer adapt. The real strategic decision was not choosing a new technology over an old one. It was refusing to let today's strongest business determine what tomorrow's business would be. Looking back, it is easy to believe that Netflix simply predicted the future correctly. History makes successful decisions appear inevitable. But nothing about this transition was inevitable when it began. Streaming had not yet proven its economics. Licensing costs were uncertain. Consumer behavior was still changing. The company's own DVD business continued generating substantial value, and abandoning that advantage would have been difficult to justify using short-term financial results alone. That is why Netflix's decision deserves attention. The company was not choosing between certainty and uncertainty. It was choosing between two different kinds of risk. One risk was investing too early in a technology that might fail. The other was allowing a successful existing business to delay the development of capabilities that could only be built over time. Netflix concluded that the second risk was ultimately more dangerous. That does not mean every decision during the transition was successful. The pricing changes of 2011 and the short-lived Q-Wixter plan demonstrated how easily customers can lose trust when a company moves faster than they are willing to follow. Those mistakes were real, but they did not change the underlying direction. Netflix adjusted its execution while continuing to invest in streaming, digital infrastructure, recommendation technology, global distribution, and eventually original content. Over the following years, those capabilities became the foundation of an entirely different company from the one that had built its reputation by mailing DVDs. The DVD business itself remained active for years, continuing to serve customers until Netflix shipped its final red envelope in September 2023. That ending reinforces an important point. Netflix did not eliminate DVDs because they had stopped creating value. The company allowed the business to continue serving customers while refusing to let it determine where future investment talent and strategic attention would go. That distinction changes how this story should be understood. The defining decision was never about replacing one technology with another. It was about recognizing that competitive advantage is often created long before a new market becomes obvious to everyone else. By the time a technology is universally accepted, the capabilities needed to lead it may already take years to build. Waiting for certainty can feel responsible. In reality, it can quietly consume the one resource that cannot be recovered: time. Netflix's transition from DVDs to streaming was therefore not simply a story about innovation. It was a story about managing success. Because the greatest threat to an established company is not always an aggressive competitor or a disruptive technology. Sometimes it is the temptation to keep improving a business that is still performing well, even as the foundations of the next market are already being built somewhere else. That is why Netflix's most important decision was not abandoning DVDs. It was deciding that the future deserved priority before the present gave it permission. And that may be the most difficult decision any successful company will ever have to make.